insurance and mortgage insurance. What are the difference between the two? What is more beneficial for you? Well, our next guest is going to help you with just that. We're joined by Andrew Bradley. He's a life and health insurance broker. Welcome to the show, Andrew. Great to have you here. First, let's talk about your role, Andrew. Describe your role to everybody.
Basically, what I do is I come in and I help a family protect against major impacts on their financial security, like loss of life, or disability or illness, where you're not able to work. One of the parents isn't able to work, provide income, and then their retirement and investment savings, kind of protect everything from maybe what ifs.
Right, and one of the biggest expenses that people immediately think of is, of course, their mortgage. Yeah. The big monkey on your back. And what happens if something happens to the major breadwinners in the home? So a lot of people might think, oh, maybe I need mortgage insurance. Yeah. So what's the difference between mortgage insurance and life insurance?
Well, the big thing is, people kind of assume that when they get their mortgage insurance, that if you pass away, it's going to pay out.
Right.
And it's, you're paying your monthly premium to it, so it's pretty much guaranteed. But it's really not guaranteed. The biggest factor is that it's called underwriting. So that's just kind of where they determine whether or not you're qualified to have insurance.
Okay.
That's not done for mortgage insurance until you put it in the plan. So the last thing you want, so the last thing you really want is to be dealing with the death and then having to file a claim, go through the whole underwriting process.
Right.
And then that's when they start with declining the coverage, and then.
So there's no guarantee with mortgage insurance. With mortgage insurance, that you'll actually get the claim because it has to come after the death. Whereas with life insurance, that's already.
It's right up front. Yeah, they do underwriting up front, and facts and prove. That's it. So if something does happen, get the check right away. There's no hassle.
Andrew, you have a little presentation you're going to show us here. Why don't we jump into the presentation here, and you can sort of describe what you're talking about here. Now, is the other idea too, Andrew, when it comes to mortgage insurance, does it go down the coverage as you pay off your mortgage?
That's right. That's the other big factor here. So just up here, just the kind of the main differences. So with mortgage insurance, again, like we talked about, the claim is that the underwriting is on the claims, right? Still not woken up yet. And then with life insurance, again, it's up front. With mortgage insurance as well, you have a blended premium. So it's a big group policy, so they just go by age. So this is a premium by age. Where with life insurance, you have individual premiums. So based on your health, and whether you're a smoker or non-smoker, there's a big difference. So smokers pay a lot more, obviously, than non-smoker. And then, like you brought up too, the decrease in payout. So over like the mortgage, the payout decreases, but the premiums.
The premium remains the same.
Actually, it goes up. It goes up, yeah. Every year it goes up. Life insurance, if you have like a 10, 20, 30-year term, that premium stays the same for the full term, so it don't increase.
And the payout is fixed, right? That's right. To be decreasing payout.
Okay, and the biggest difference is that for the mortgage insurance, your bank gets the money, and life insurance, your family gets the money. So the key there is, I guess, the family has more flexibility.
That's right, yeah. The mortgage insurance pays just the balance of the mortgage, whereas with the life insurance, that money goes to the family. So, whatever their immediate needs are at that time, they not want to pay off that mortgage. Right. Unfortunately, there's other things they need to take care of, so they have that flexibility. Whereas with the mortgage insurance, the money goes directly to the bank. So.
This is a very important, clear distinction that we need to make. People out there are really, but I'm sure a lot of people out there aren't quite aware that these are the major differences. So how do you determine then whether or not you need life insurance, or what kind of coverage you need? What are some of the things that you should be looking at?
Basically, is when you kind of look at your liabilities and your situation, your family, your children, taking care of them in the future, their education, and any debts. Looking at all your debts, liabilities, and kind of what you kind of want to do if something does happen. You want to maintain your lifestyle, maintain the family's lifestyle, replace your income.
Right.
So that they have something to keep going while they're kind of dealing with the situation and that impact. So
obviously, you need to shop around for life insurance. What about how often should you look at your life insurance? Let's say, I get into a fixed term. I'm looking at 20 years and I lock into that 20 years. Should I still be reviewing it on a yearly or every 5-year basis?
I think the time we should really renew it, review it is kind of any kind of life change situation.
Okay.
Changing job, salary increase, you purchase a bigger home, or you have a child, or something. Some kind of life event that changes you should look at. But it's always good to kind of review everything once a year, so you're caught off guard. The end of your term is next week, and then you got to renew and all. You got to search for it, so it's good to have. And, really, with mortgage insurance, it's really right now, especially with the spring and summer kind of housing market busy time now, everyone's rushing to get a mortgage.
Right.
The other big thing too I want to bring up about mortgage insurance is that it's usually a lot more expensive too. And I'm actually going to show you how to save $37,000 with a life.
Okay, let's do that quickly before we run out of time.
Yeah. So we'll just skip that one. So this is just a coverage from from all the banks. I went online just to price it out. So we were like from age 30 to age 65. This is just $350,000 coverage for a male non-smoker.
Okay.
Didn't put the bank's name, but I put the colors.
Clever.
So you can see, over the life of the mortgage here, total $48,000, $55,000, $46,000. That's what you would pay up to age 65.
Okay.
So, and as you can see, the premiums jump pretty significantly in 10 years.
More than double.
Exactly. So here we get life insurance. So you can get a term insurance that's to age 65. Premium starts at $43, and that stays the same at age 65. So you're only spending $18,000.
That's a huge difference.
Yeah. So just imagine what that would do for your life of your mortgage. So when you take the highest at 55 minus the 18,
Yeah. That's a lot of money.
$38,000 that can be used for a lot better things.
Well, yeah, and you buy a house and you're sitting there with the banker, you're getting your mortgage right off the bat, and sometimes it's just a simple, check it off and then you sign it and then you're locked in, right? Well, Andrew, this is great advice, great tips. Thank you so much for joining us today. Really appreciate it. Again, make sure you do your homework. We're back with the ceremonial guard. Don't go anywhere. We'll be back with them right after this.